Hello and welcome back to our online course and technical analysis part 1 session. In this video, we are going to understand technical analysis, the basics of it, and then we are going to understand the candlesticks and various kinds of candlestick patterns. So if you know all these things, the technical analysis, the basics, the candlesticks, you can directly skip this portion and go on to the next video. But for those who don't know, stick around with me. I'll make you understand. These are very easy concepts which are literally made difficult to understand with the help of jargons. So don't worry, these are very easy to understand things. Once you understand the concept behind all these things, they are very easy. So let's start off by understanding what is technical analysis. So since you got into markets, you must have heard of this term TA or technical analysis a lot. But what does that exactly mean? Well, technical analysis, in my opinion, is the easiest way to understand financial markets at a micro level. Technical analysis is also the way to analyze markets and predict the upcoming price fluctuations of any particular asset, like any stock or commodity like gold or silver, by studying its technical graph. Now, what exactly is this technical graph? The thing you're seeing on my screen right now is called technical graph. What does technical graph mean? It comprises of many things like candlesticks, volumes, indicators, blah blah blah. We'll get to that later. But for now, let's understand what technical graph means. Well, technical graph basically is a thing which helps you analyze the upcoming price fluctuation. So basically, this is all basics of technical analysis. These candlesticks, indicators, volumes, this graph and all these things, they all comprise of technical analysis. So this graph, it is here. This is, let's say this is a stock, okay? And now you have to analyze where it is going to go in next 3 hours. So how are you going to find it? You just cannot flip a coin and say heads, it's going to go up and tails, it's going to go down. No, that would be gamble. So there is some logic, there is some maths, there is some science behind it to understand or analyze how these stocks or commodities perform over time. And that is done with the help of this technical chart. Now, technical chart, as I say, comprises of many things, indicators, volume, but we'll understand that later. For now, we have to focus on these little things that are there. These are called candlesticks. So to understand candlesticks in a better way, we have to go back to our normal day-to-day life where we text or send a text message to someone. So when you text a message to someone or when you're texting, you use those emoticons that are there, right? We all use them. We use those thumbs up, thumbs down, smileys that are there, the crying smiley, the laughing smiley, and all those things. So what they do is they basically convey our message in a better way and show our emotions at that particular point of time. So let's say a friend of yours sent you a good joke. You sent a laughing smiley. What does that mean? You probably are laughing at that particular point of time, which means that particular emoticon is showing your emotion at that particular point of time. This is exactly what candlesticks do when it comes to markets. These little candlesticks are basically the emotion showing thing of markets. They come in various patterns and all these things, but there are two types of candlesticks when we think in the bigger context of things. So first type of candlestick is basically that which goes up, which means which is a green color candle here, which means the market is, which shows us the market is going up. And the second type of candle or candlestick is the type of candlestick which takes the market down or shows that the market came down. So basically first candlestick shows that the market is going up. Second candlestick, which is the red one, shows that the market has come down. So to understand these detail of these candlesticks, let's head to the basics of it. Okay. So this and now this, you might see some similarities here and there, but because they come in various patterns and different types of shapes and forms, there are some differences as well. But the basics remain same. So let's understand the basics of candlesticks. So here is a green colored candle and here is a red colored candle. Now green colored candle simply says that the market went up in that particular time, and red colored candle says that the market came down in that particular time. Now as you can see, open, low, high and close are the same things that are mentioned on both of these candles, which means the terms and the concept remains both for same for both candles, but there are slight differences, and we'll understand that now. So first let's understand this green colored candle, which means this candle is showing us the market went up. How? Let's understand it in detail. So here you can see open. So this is basically this lower point is basically the open of the market, which means this candle opened over here. This is a low, which means the market came down over here in this particular candle. This candle came down until here, then this is high, then it went up until this particular point, and then closed over here. So open and close. This is open, which is where the market opened, the candle opened. This is close, this is where the candle got closed. And high and low, high and low is basically it made those points. It went up until this particular point, and on the lower side it came down until this particular point. So these points are marked as high or low of that candle, and the open and closed are marked from here to here. Now, as I previously said, that this is a green candle, which means this is a positive candle. And what is positive? Positive means going up. So that is why its open is below close, which means open is on the lower side and close is on the higher side. Okay. So this is a positive candle, a green candle. See, so it opened over here and went up and closed over here. Exactly opposite of it is basically a red candle. Now, high and low points remain same on the red candle as well, because those are just high and low points. But what differs over here is the open and close points. So red candle, which says the market came down. Okay, so that is why the open is at higher side. Okay, and then it went up maybe, and then made this high, and then fell down, made this low, and then finally closed over here. So because the market came down during this particular candle, open is on the higher side. See, you can see open and high are on the same side, and close and low are on the same side, which means the open is on the higher side and close is on the lower side because the market fell down. On the contrary, when we see the green candle, open is on the lower side and close is on the higher side because the market went up and closed in positive. So this is the basic understanding of how candles work. So they open and they have open, close, high and low. They have these values. High and low of any candle does not change. I mean, the high is the high and the low is the low. It does not change depending on the color of the candle. But open and close changes depending on what kind of candle it is. Is it a positive candle or is it a negative candle? So positive candle has open and low on the open, it has open on the lower side and close on the higher side, while negative candle has open on the higher side and close on the lower side. Now this is the basic understanding of how candlesticks are formed. What are the basics? These are the basics of candlesticks. So now as you can see, these candlesticks are basically the same. I mean, yes, they are a bit different because they come in different patterns and shapes, but the basic concept remains the same, which means any green candle says that market this has open, this has a low for this particular candle. If we see right now, any green candle you take, so this candle, let's say this has open over here, high over here, this high, low somewhere over this point, and this is the close, which means the market went up. See, the market went up. And let's now say this red candle. So red candle has open over here, low over here, close over here, and high over here. So high and low points, as I said previously, do not change. High and low are same, but open and close change because the market came down, open was here and close was here. So this is the basics of candlesticks. This is how we understand candlesticks. And now we'll understand different types of candlesticks. So there are different types of patterns and things that form in these candlesticks. So let's understand that now. So there are names, okay? There are different types of names to different types of candlesticks, but to be very honest, you do not need to remember those names. As far as you understand what that candle is trying to say, you do not need to remember those names. All right. So all these candles are different types of candles. So let's understand one by one. Let's look at this green colored, full green colored candle. Now, if you focus on this particular candle, you might see there is no wick or shadow. This particular thing, this high and low thing, we call it wick or shadow, like this candle, high and low. And this is called the body. So the colored part is called the body, and this thin line on the upside and downside is called shadow. So if you can see, this candle does not have any shadow. What does that mean? How is that possible? Well, it is possible because it opened, and as soon as it opened, it started going up. It never came down. It did not came down even for a second, and because it did not come down, it does not have a lower point. So how are we going to determine the lower point of this candle? It is pretty easy. What is the open is the low. Because it did not go any lower than the open, this candle is called a open low candle. Open is equals to low, open low candle. So the open and the low are same levels. And then it kept going up, and it closed at the most highest point. So as soon as the candle closed, it closed on the highest possible point. So this is a high close candle, also open low candle and high close. Now this is a Marubozu candle. Its name is Marubozu, but you do not need to understand the names or do not need to remember those names as far as you understand the concept. Now what is the concept? This candle is the most bullish candle of all of them. Why? Because what have we understood in previously, that whenever a green colored candle is formed, market has went up, market is going up. So now market opened, and then it started going up the moment it opened, and kept going up until it closed. So this kind of candle says that the bulls or the buyers, bulls are also called buyers and bears are called sellers. So bulls completely dominated this particular candle, hence it is most bullish candle. Okay. Similar on the downside, as you can see, there is a same red colored candle. Now these are exact opposite candles. This green colored candle says that the market opened and started shooting up the moment it opened. But what have we learned about red candle? We have learned that open, and the open is towards the higher side of a red candle because the market is coming down. Its open is on the upper side and closes on the lower side. Now here also we do not have any shadows to this particular candle, which means the market opened and started shooting on the downside as soon as it opened, and it kept going down until it closed. Now this is also most bearish. The concept is same, just the two sides differ. This is a upgoing side, this is downcoming side. So it opened, and as we can see, we do not have any shadows over here. What does that mean? Which means there are no shadows, and hence the open and high of these candles are at same level, and low and a close are at same levels. So this is a open high candle, and this green candle is a open low candle. Okay, this is the most bearish candle, and this is the most bullish candle. Why? Because there was insane momentum from bulls in this green candle and insane momentum from bears, sellers, in this red candle. Now let's understand this particular candle. What happened is, so this green candle opened over here, it came down, until this point, it made a low, and then the bulls showed their power. Then the buying came, and then it went up, and even went up than its original opening point and closed on the highest possible point. Now this is again very bullish candle. Why? Because if you can see, the open is here, and this wick which is formed says a lot about markets. These shadows that are formed say a lot, which means that this market started coming down as soon as it opened. It started coming down, but then bulls showed their power and pushed the market on the higher side. And whenever the market comes down, and goes up or goes up and comes down, it makes a wick. Okay. So anything that is outside of open and close is called a wick. So because the market came until this point but could not close, it didn't form body over here, it formed the wick or shadow. Where did it close? It closed over here. So open and close are here, low is here, and as you can see the high is not there. So the closing point is also the highest point. So close and high are same. Now this is again very bullish candle because it opened, it started to push down, but then buyers overtook those sellers and completely devastated those sellers and went up above those opening points and closed on the highest possible point. So I hope you are getting the concept because it's easy. It's just about open, high, low, close, and the low and high points, they do not vary or they do not change according to candle. Only the open and close points do. Also, just because the candle is coming in different shape, the open or close is not going to change. The concept is going to be same. Like in this candle here, the you now you tell me where is the high. Okay, I'll give you 3 seconds. So for those who figured it out, congrats. This is the highest point. So this is high, this is low. And where is the open and close? So where is the body? That body is basically signifying the open and close. So this is the open point, this, and just immediately above it is the close point. Now, as you can see, we saw these bullish candles right here, which means the positive candles. This is a neutral candle. Why? Because as you can see, the open and close are very near to each other. But there are huge shadows on each side, which means the market opened over here, went down, then went up, and then closed over here. So, which literally means no one could capture this particular session, nor bulls, nor neither bulls nor bears. So, this session of or this candle was a neutral candle or a neutral session because no one could dominate their control or show their control. No one could dominate this particular candle. It was a neutral candle. Similarly, this candle right over here, this is the most neutral candle because the opening and closing point are at the same level. The open and close are at same level, but the high and low are different, which means there are huge shadows on either side, and open and close are at the same level. What does that mean? Which means the market opened, it either went down or went up. So if it went down, it came down, then it went up and then closed over here. Or if it went up, then went up, went down and closed over here. There are multiple ways. But the point is that no one, which means neither buyers nor sellers could dominate their this particular session, could not show their strength in this particular session. So this is a neutral candle. Now these two candles are interesting candles because as you can see, the open and close are at same levels for both of these candles, but they have a huge shadow on only one side. So now this candle, as you can see, it opened over here. It does not have any low. So any candle that does not have any low, which means that the candle started in a bullish momentum. It opened and it as soon as it opened, it started going up. It blasted. But then the bulls came in, the bears came in, the sellers came in, and they sold off and they just recaptured what this candle had gained and then closed at the very point it had opened. So this is again a very negative candle because it is not neutral because just because it's open and close are at same point does not mean the candle is neutral. This is a very negative candle because all the dominance or strength that was showed by the buyers was recaptured by sellers. Okay. Similarly, this candle open and close at same point, no high, which means any candle which does not have any low, which means it started in a bullish momentum, and any candle does not have any high, started off in a bearish momentum, which means this candle started selling off as soon as it opened. Opened over here, started selling off, came down, came down, came down, but after one point, bulls showed their strength and recaptured all of those things, all of the place, all of the candle which bears had taken over. So this was a complete dominance by bulls in this session and complete dominance by bears in this session. So this is a first candle is a neutral candle. second candle is a very bearish or negative candle, and third candle is a very bullish or positive candle. So I hope you're getting these concepts right, because once you understand the concept, it is just a play for you. So as you can see, this is a red candle. So it opened over here, it went up until this point. So this is the high, came down, this is the low, and this is the close. So this is very basic, similar to this candle we saw a few minutes ago. This is a negative candle, which means the candle closed in negative, but this is actually a very positive candle. Now I'll show you why. Because it opened over here, did not make any high, which means it started going down as soon as it opened, went down until this point, and then bulls showed their strength and closed over here. So if you see closely, this candle and this last candle is pretty much the same except for their opening and closing points. So these two candles have similar interpretation that the bulls are taking over. And this candle, see this candle, although it looks bullish, they say it's least bullish because just for the name's sake it's bullish because green color is there. But as you can see, the bears are completely taken over by the whip, you can say, by the shadow, you can say that. The bears have completely taken over, the sellers have completely taken over this candle. And this candle and this middle candle, second candle, are pretty much the same. So their interpretation is pretty much the same as well. So this is again a bearish candle because it opened over here, went up high, but then bear said, no, you are not going anywhere. We are selling this down, and they started off the selling. And then it came down and closed over here. So as you can see, the bulls only dominated about 20% of the candle. This and almost 80% of the candle was dominated by sellers. So it was a bearish candle. Like this candle, in this candle, 100% there was domination by bulls or buyers. So it was a bullish candle. And in this candle, there was 100% dominance by bears or sellers. That is why it was a bearish candle. So you have to see the dominance of who is dominating how much. And depending on that, you have to decide whether this particular candle is a bullish candle or bearish candle. Just by the color of the candle, it does not mean it is bullish or bearish, because as you can see here, this candle is a bullish candle. But just by the color, if we say it is a green candle, so green candles are positive candles. You might say, Shrish, you just only told that green candles are positive. No, but to get the context is important. The color is there for just a understanding purpose, but just because it has green or red color does not mean it's a bullish or bearish. You have to understand the concept. You have to understand who dominated how much. So in this candle, as you can see, it is a red candle, so you might say it is a bearish candle, but no, look closely. The bears dominated only 20% of this candle. This wick was created by the bulls, so it opened, did not make any high, which means it came down, started banging down. But then bulls said, we are coming in, buyers said, we are coming in, and they pushed the price higher. So they dominated, the buyers dominated over 80% over here. The bears, the sellers dominated only 20%. All right. So you have to see the context of what is happening in there. It is just not about the color. You have to understand the concept. So now that you have understood all these types of candles, you might just want to watch this video again if you are not understanding or you are not getting what I'm trying to say. If you're not getting the context, just stop the video, go back again and repeat, because until and unless the concept is clear, you are not going to understand further the topics of our session. So as you can see in this chart, now you can understand what is going on over here. If you look closely, these patterns are not very different from these patterns, right? Yes. So let's now move to our next thing. And now we are heading towards multiple candlestick patterns. Now this is where the patterns come in, where one or more than one candlestick come together to form a kind of pattern. Again, there are names and all, but you do not need to remember those names as far as you understand the context of what is going on. So this is a bullish engulfing, bearish engulfing, harami, and dark cloud cover. Now this harami thing is a Japanese name, so don't take the Hindi interpretation of that thing. But bullish engulfing, let's ignore the names again. I do not want to confuse you with the names. Let's understand the context. So first candle, this is the first candle and this is the second. Say the same applies everywhere. This is the first, this is the second candle. So first candle was a normal bearish candle, opened over here, made a high, went low and closed over here. But what happened here was after this candle, the next candle opened gap down. Now, if as you can see, the close is here, which means normally what happens is when a candle closes, the next candle usually opens next to where it closed. That is how markets usually operate. But sometimes there is momentum, heavy momentum, or heavy buying or selling done by institutions. So gap up or gap downs also happen in intraday trading. What is a gap down basically? So after this selling pressure, this negative candle by the bears, they push the price very, what we can say, they push the price in an instant towards downward. So even before the next candle was starting, people were so eager to punch sell orders that the next candle opened gap down. This is a gap. As you can see, this is a gap. This is open. This is sorry. This is a close of this candle, and open of this candle is over here. So there's this gap in between, and this is a called. This is a gap, and because it gapped down, we say it is a gap down. So even before there is 1 second of time, which means 1000 milliseconds of time between closing of this candle and opening of this. There is 1 second of time, and in that 1 second people were so eager and so you know uh, eager to sell that market, or sell or start punching the sell orders, that they actually made the next candle open gap down. So this is a gap down. Now gap down, what does gap down or gap up say? Similar to gap down, there is this gap up. What does this say? Gap up or gap down says that there was huge momentum by one particular side, buyers or sellers. So here selling pressure was there, so gap down happened because of huge selling pressure. So the next candle, first candle was a bearish, then there was insane selling pressure which led to gap down. But now the second candle, as soon as it opened, it went a bit low and then it just blasted up and went and closed above the high of this candle. Now, this is where the interpretation and context of candlesticks and pattern comes in. It's not just one candle or two candle, it's understanding how they work. So this candle closed above the high of this candle, which means the bulls completely dominated this particular session, and not only this session, they completely dominated the previous session as well. Because although this candle was bearish, but now they completely closed this candle above the high of previous candle, which means in previous candle bulls were not even able to pass this point, and now they have just closed the candle above this point. So this is very bullish pattern. So that is why it is called bullish engulfing, because this particular candle is just engulfing, is just eating up the previous candle. It is called a engulfing pattern. So this is a bullish engulfing because the bullish candle is big and bearish candle is small. Exactly opposite to it is a bearish engulfing pattern. So as you can see, first candle was a normal bullish candle, and then it went up, closed up, and then here's the gap up I was talking about. So closed over here, opened over here. So that means in that 1 second between its close and its open, people were so eager to punch buy orders that the next candle literally opened gap up. So it opened gap up, went a bit high, but then the seller said, we are done with this, we are selling it out. And they sold it, and just completely devastated the dominance that was there by buyers. They closed that candle below the low of this candle, which means the bears were not even able to pass this point in previous candle. But then they said, we are done, and they gave it all, and they closed below the lower point of this candle. Now this actually gets very bearish, as just like this particular candle closed above the high of this candle, which is a very bullish sign. Something that's closing below the low of previous candle is a bearish sign. So that is why this is a bearish engulfing candle. Again, the pattern is the same, colors are different. So this red candle or bearish candle completely engulfed or ate up this green candle or positive candle. That is why it is a bearish engulfing candle. Now similar kind of things happen over here. This Sarami pattern, a good green colored candle, and then slightly red colored candle, but as you can see there is this gap down. Now to explain this particular pattern without any context of chart, it is very difficult. So we'll just skip this particular pattern because there is no context and it won't really make any sense. But this particular pattern is dark cloud cover. This particular pattern is important because as you can see, these are very big green and red candles, which means there was huge momentum in each of those candles. So this candle opened over here, closed over here, gapped up. People were eager to buy, but then it opened and started selling off. It made a little bit of high and then started selling off and then closed below the midpoint of this candle. So the midpoint, higher point and lower point are three very important points for a candle. So anything that closes above the high of previous candle is a sign of bullishness. Anything that closes below the low of previous candle is a sign of bearishness. And this midpoint you have to decide with understanding by understanding the context of what's going on. So here it it was a buy candle, a positive candle. It opened gap up, but then seller said, no, we are done. We are not letting this market go up, and they came down. They could not close below the low of this candle. So which means it is not as negative, but it is still very much negative because they managed to close below the midpoint of this candle. So I hope you're getting this because it's pretty easy. The concept is easy, and once you understand the concept, it is just a child's play. So here are more patterns, three inside up. So these three dash or three lines indicate that the market has been falling, and then it again makes a red candle, and then it makes two green candles. So again, this pattern without any context is useless. So let's ignore this. You have to understand the concept of where this pattern is forming. Like there is support and resistance. We'll understand support and resistance later, but what basically is a support is a point from where market stabilizes if it's falling and reverses back towards upside. If the market is falling, like from it's coming down, it stabilizes and then reverses back towards upside. And resistance is a thing where if the market is going up, it stabilizes over there and takes resistance and starts reversing down on the downside. So this is basically the concept of support and resistance. So you have to understand where these patterns are occurring. You just cannot see them anywhere and say that this is a three inside up candle or three inside down candle and whatever. Just take decisions based on it. You have to understand the concept. Sorry, the context. So three outside, again, just ignore the names. The market has been falling. Now let's say this is the support over here. Okay, let's say this is the support level. The market has been falling, and here you get a bullish engulfing candle pattern followed by another green candle. Now this is a very strong reversal pattern, especially when it occurs at a support level. All right. So if it's a support over here, support means it's a level where market may stabilize. It's not, it should, it may stabilize and reverse the direction. But how do we know? We come to know by the help of these patterns and candlestick charts. So this is a kind of sign that the market is stabilizing and reversing back from here. So when you see a pattern like this at a support level, what you can do is you can buy that particular market or go long on that particular market by keeping your stop loss order below this. All right. So three advanced white soldiers. See, just ignore those names. Uh, Coming down, market has been falling. So these lines indicate the market has been falling. It is coming down. And then you get these continuously three upside going candles. Now again, the context is important. If they are coming at a support level, it is a very bullish reversal sign. If it's just randomly popping up somewhere, they are useless. Okay. So the market is falling. Here you get a sign of neutrality. So as we saw in the previous candles, what is this candle? This baby candle here is neutral candle, which means no one could dominate this particular session. So if the market is falling and if you get a sign of neutral, then which means bullish signs may be seen sooner or later. So here over here, after this red candle, you get this green candle, which literally says now this is a reversal pattern. Again, you have to see where it is occurring. You need this at a support level. Random occurring of this particular pattern in some random place won't make any sense. So like this, same concept is there. You have to understand the concept. Like let's take this. One green candle, two, three red candles, and then again a very big candle. So this, what does this say? This just was a trap for people who are buying over here. So this was a stop loss hunting thing. We'll get to these things later, but understand all these things. This concept is very easy, and once you understand the concept, the understanding all these things becomes pretty easy. So I hope you have understood the concept of these open, high, low, close, and candlesticks and whatever that I explained in this video. If you haven't, then make sure to watch it again. There's no issue there. But I'm also attaching a link of one playlist of another channel. That guy has explained candlesticks in a drawing presentation format. So literally like when the markets are opened and how the candles behave. He has explained in that particular format. So I think that will help you a lot to understand the basics and clear the concept if you haven't already. So just understand that thing as part of our course and head over to those videos after you have watched this particular video. So we'll end this session over here. In next session, we will understand the price action patterns that are there, like the head and shoulders, the pennant, the flag, and all those things, and understand how it works and why it works. So let's keep this one short and sweet. It is not actually short. I know it is long video, but I want to get the basics of you guys cleared before we dive in deep into understanding the bigger concepts of market. So until and unless the base is not cleared or the base is not strong, you won't probably make it until the end. So I want the base to be clear, and that is why this video is a big, probably the next video is going to be a bit bigger as well, because that is again a basic video. And once we are done with the basics, once you have understood the concepts of how the chart operates, then we can take up the pace. So I hope you learned something, and if you did, then make sure to let me know in the Telegram section. You have my access of Telegram or Twitter. You can let me know over there, and I will see you in the next session. Bye bye.